Oh, brilliant. Thank you very much, everyone. Thank you again for spending your Saturday afternoon and early evening with us. And I hope all had a exciting, good week. We have another episode. We're gonna talk about the week we had and the week is coming up. So, um, what I like to do first, I give you an outline of what we'll be looking at this week, and then follow up with that. So, as always, I like to review the economy briefly. As we can see now, there's a little more convergence of markets and the economy. Obviously, with what was happening last week, we talked about the Congress before they left. Pelosi and Treasury Mnuchin, they're getting together. I mean, this would have been it before going for the campaigning. We had our debate, and we had also with the non-farm payroll, we talked about that. And on top of that, last week, as I mentioned, the COVID was accelerating in in from South Korea going to, especially in Europe. We're talking about from Russia to Spain. So they all hand in hand, and it is playing a little factor now, the economy, the COVID, and of course, top it off on Thursday night when you hear the news from the president and the first lady um, with the COVID story. And I don't know if you were up seeing that. I was right. The markets just immediately took a dive. It was amazing to see, and I've seen it. It's like almost like any other kind of a crisis oriented. You can see how markets overreact, and they really reacted, within minutes. So, uh, what I like to do, if it's possible, one of the differentiations that, I'm glad we are all together. So, it is important the review of the economy and the markets, and we talked about the lessons, and every week I hope to give some new ideas and trade of the week. One of the important things is the difference between this, like being in the classroom. This is like real money, and that's what our again um, what we talk about is education, application, and then inspiration. So it's after you, most of you actually trade. So what we learn, it's something that you can actually put in use immediately. And I think that's the best form of learning because it hits home and it hits your pocketbook. So, and I'm so pleased, you being part of this. And again, I've said it before, you're like the pioneers. And that's why I like to ask you to sometimes go back and let's say last week's video, put the speed up. I usually, when I watch YouTube, I put it on speed 2, 1.1.5, and just review some of the things happened a week ago, 2 weeks ago, the things we talked about, and refresh your memory and see how the things panned out and some of the things that you thought it it could need some revision, and looking at things and some of the things that they you thought, well, that was a really good call that you did and you applied it and it worked. But what was the basis of everything's happening? So that's what I think is important. And that's what I'm, again, so pleased to be part of this group. As I mentioned, we talk about the economy. As always, we talk about the markets. Last minute, I decided, let me put the lesson of the week. I think for like 3 or 4 minutes, just talk about what we learned last week and what hopefully give you a little bit of a tip how you could use these lessons. And then we will have a commodity of the week because something interesting happened on Thursday. So I thought that would be a good idea to have commodity of the week. And then we always have the trade of the week. So first, let's start with the economy. As always, we look at the Department of Labor statistics, and we look at what is really happening, not what the news are telling us, what is the government is telling us. This is what's in reality happening. Then unemployment numbers, as you can see, we cannot really look at year over year. Basically, we try to look at month over month, but there's a lot under the hood. As you know, Friday was the non-farm payrolls. the rates did go up, but there's a lot of discouraged, uh, discouraged employees, or I mean, people who are unemployed people. So they're not part of the group. But also, on the other hand, some of the numbers were affected because of still the schools are still virtual. Some schools are opening. I know in California, starting next week, we're going to have the hybrid. We're going to have a half and half. And what happens is because of no schools, you don't have the custodians, you don't have the bus drivers, for instance, some of the teachers. So that numbers have been, again, changed. So there's that balance. Interesting thing is, that the weekly retail are, kind of improving. It was interesting that some of the actual retail stores stocks are doing a little better. Um, I don't think it's going to be a long time before people start going to the to the movie theaters. So that's very much shown. So a small number shows a big change week over week and month over month. And the interesting thing is the rail car. We're going to talk about the transportation. So you see people are still shopping. Obviously, there's a lot more with the FedEx and UPS. There's a lot of people still at home and being delivered. So that has really, when you look at a year ago, we're only down 2%. Hotel occupancy, although it is, still hurting, we really just leveling off. But you can look at the average daily rate has been higher than what it had been before, but when we look at, a few months ago, I was looking at, so we are looking at, but this is the most important thing. So when we analyze the hotels, we look at and the same thing with airlines, we look at per seat. What is the revenues per seat? It's not like how many flights they have and how much money they take per person. It's what is per seat, and this is available room because of, again, they have to be very careful, and you can see we are 50% off. So these are the things, again, with the new COVID situation happening, and then with the president's news. So I don't know how many more people deciding to fly again. So that's what is going to affect the airlines even more. And we will talk about the oil. One of the most important thing is, again, the economy. We talked about the debt, and then last week, and the deficit's going to produce. Right now, what is happening, we are pushing the zero interest rate. It's going to be with us for at least next 3 years. So that has been the blood of the economy right now. But when you look at the small businesses, this is from the lending tree. And as you can see, the majority of the small businesses have been really affected, and we still haven't seen the full impact of that. So you can see at least 6%. The projection is about 25% of these small businesses are going to be out. I mean, they're going to be completely closed. So that's very important to think about what is happening with this economy. Once we get to the markets, we will talk about the effects of, again, what is happening as far as the election goes, mixed with economy. And because it's happening in exactly a month, actually, what we're going to have the election, majority of it looks like, forget about the betting sites, and with the news, with the President Trump, obviously the odds are becoming more and more in favor of Vice President Biden. And when you go under the hood, you analyze what stocks and what sectors. And when I say sectors, I think we will do one maybe next couple of weeks, talk about which uh, party will affect the sector. So we talk about managed care, for instance, the healthcare side of things, the green technology, for instance. And then we talk about the financial services, regulations versus non-regulation. So, there are studies done, and they look at, as far as that goes, even like Friday, with the effect of COVID. And, obviously the polls show there's a gap for Vice President Biden. and is in favor. So we look at how is the Europe is looking at what is the as far as the European stocks that favor more maybe democratic um, sectors. So they've been outperforming. You know, if President Trump was reelected, you look at what is happening with the sectors, and it looks like more democratic favorite sectors are overperforming the the Republican sectors. And then we look at what is Asia doing with the tariffs and China. So these are what is happening under the hood. So basically, it seems like the markets are taking into account that it could be a, if not a sweep, it could be a President Biden, it would be President Biden rather than President Trump. The, the word of caution I give this was happening similar 4 years ago, and it was even more so with the president. At that time was um, at that time Secretary Clinton versus President Trump. So basically, I watch these, but just watch it with a grain of salt. So just don't fall completely into that. But I think it might be a good idea in the next couple of weeks, see which sectors will be favored again than one party over the other party, whether there will be a sweep. That's actually the House and the Senate is more important to Congress than even the presidency. So that's what we will be looking at. The other thing is, as you know, we talked about last week with the what's going to happen with the stimulus package. That's huge. So with a lot of unemployed people with Disney's news, 28,000 more unemployed from being laid off by Disney, American Airline, United Airline, they're laying off. So these are all playing a role to to even have more push for the some kind of a package. So uh, I understand, I guess, House Speaker Pelosi and Treasurer Mnuchin, they're still talking right now. On the other hand, three new Republican senators for the Senate, they they came with the COVID case, and I think what I heard was Senator McConnell had said, well, there won't be any meeting for the next 2 weeks. So we'll see how all this pan out. So we are definitely in a world that a year ago we would have never imagined. So when you look back, beginning of the year in January, who would have thought we would actually talking about things like this? So one of the things about COVID also is now it's like it's hitting home. It's a lot of people. And I know in our circle of friends, we've seen many more people who've gotten it, and thank God they're doing all well. So it's all about your immune system, and as you know, it affects much elderly people. But it looks like unless you're sitting at home in one room, it's not really that much of escaping it. What has changed is like managing it. So and that's what it's important, and now there a lot of companies are working on it. But as far as like really avoiding it, it is very difficult to sit at home, in a cave and just for a year, 2 years not go do anything. So that's I mentioned last time, soccer practice is starting, and we got this regulations that every kid has to be 10 feet apart, and that's kind of limiting in activities. But we'll see. I think eventually, I mean, are we gonna go? I don't know if we can go like Sweden's plan. They just said, well, let's everyone have it. Much smaller economy, much smaller country. On the other hand, we cannot choke the economy in this country either. So there has to be a happy balance. So that's what's happening. So it is again, we still got more exciting weeks ahead, more volatile weeks ahead. Having said that, let's look at what happened with the markets, because um, what we did last week, if you recall, that's why I want to go back. It looked like, a lot of indexes, if you recall, we had the sell-off and we had the flattening, and then we hit our supports from there used to be 200-day to 50, depending on what index you're looking at. So we knew, based on our event, the expected movements we talked about, there would be a bounce. We didn't know how much, and obviously, um, Thursday night news about president took the markets by surprise and affected different asset classes. But as a whole, because of that bounce, you can see there's kind of a steady movement in a bigger cap. So when I say like Dow Jones Industrial, the top, the 30 companies, they were at 1.87, S&P was 1.52, and NASDAQ was 1.48. And these are like really in harmony. The interesting thing is when we go and look at, for instance, utilities, which are more defensive, they were up actually 3%. And then we look at the mid cap and the small cap, including like Russell, they were up over 4%. So it looks like there is this connection, and that's why we're gonna actually analyze a little more when we're doing the charts. What is happening? Why there's this disconnect between like the way NASDAQ and the big cap technologies um, behaved on Friday was completely different than the way the Russell 2000, for instance, did. You see a lot of technology stocks were really down, yet the financials actually were in the positive. So we will look into that. If you recall, the week before, the advanced declining line was like 1 to 4. But on the other hand, we come back the following week, which was last week, we were over 3 to 1. So that's, again, could have been a technical bounce. Is it because the markets are, again, with all that volatilities, you would think that is this really a big movement? Are we going to go up this week, basically based on that bounce, which we will evaluate? And then the dollar, as you can see, was kind of flat. We will see how the dollar behaved. As you know, it had a nice bounce, and which affected the silver and gold. In the meantime, you can see the oil market has been just in the last 2 weeks, it's been and especially last week, we talked about the COVID case, so it directly affects the oil market, the demand, because especially in Europe, what is happening. So because of that, again, the demand goes lower. And again, the situation with president, that didn't help the case. One thing is, I'm sure the president is getting the best care, so it's not like and I think that's what the markets told us on Friday when we were down over 500 points, and yet we came back up. And interesting was that the NASDAQ was the biggest as far as the losing points. NASDAQ was the biggest percentage loser, while, as you mentioned, small caps actually were up. The gold was up a little bit. We talked about the bounce, and we will look at the charts. You can see we're stabilizing with our market sentiment with the Citigroup panic euphoria. And I go back, remember, end of August, we were like in a big extreme, and we needed that, cleansing. In the meantime, the same thing with the CNN fear and greed. You can see now we are getting more and more with what is happening with the sentiment of the 7 things and the factors that they use. So we were at like 78 not long ago, or 77 a month ago, and here we are. So let's look at the charts. So let's start with the S&P 500, the cash index. As you can see, this is the Bollinger Bands. Last week we were oversold. We bounced back up. We were right on the 100-day moving average. So this is where we were outside the Bollinger Bands, and we came back on oversold, coming back, and we usually go and kiss our 18-day. This is for the futures. This is for the Bollinger Bands. I use the 20-day. This one, I use the futures market in this cash. It's 18 days. So we usually come here very close and kiss that. So we are really kind of just flattening. You can see there's that they're just sitting right on that 18-day. On the other hand, when I looked at can see last week again, we bounced off. This is the 55 days. I use the Fibonacci number 55, 34, and 8. These are exponential, but 50 the same thing. So this is what happened. This is where we were last week. We broke above the 50, and now we are just sitting right on 34 and 8-day moving average. So it's important to see what's going to happen. So this is the futures E-mini 500. The interesting thing is that the volume was about a little over 2 million, but almost 1/4 of it happened overnight. So actually Friday was not as active as it should have been. A lot of things were happening overnight. And what happened again, you can see we bounced, we hit uh, overnight, we hit the 55-day moving average, and we just closed right above with the support line. So I know a lot of people use fundamental analysis. Again, maybe the technical and the charts are more self-fulfilling prophecy, but this is how it is. I mean, these are done before, and the markets respect that. So it's important for you at least have your eye on it to see some of the, especially if you're doing trading, to see what are some of the crucial points. The same thing, like I'm looking at the 50-day moving average on a weekly basis. Oh, so so what you can see, this is on a weekly, S&P weekly, like you can see on a weekly, we went outside the Bollinger Band, came back and kissed the 18-week moving average last week, and we bounced out. So, and we're kind of looking at to see what the stochastic is there and say. Last week, as I mentioned, it's like with the daily, we want to be over 50 if we want to see there's a buying power coming in. Now, the Bollinger Bands are in a weekly event, they're narrowing, and this is a theme I want you to think about. The election is coming, there's COVID, there's stimulus, but let's see what is happening with the markets, with the Bollinger Bands. As you know, Bollinger Bands are the volatility bands. They're the standard deviation away from the mean. And yet, I'm looking at NASDAQ, which had the big sell-off, and these were the big cap leaders, and we went right on the 18-day and stopped there. So this is very important to see what's going to happen to stochastics. If this turns down and then it's under 80, that tells us that that's overbought, and we will continue to go to the next support, which is the lower Bollinger Band and then the 100-day. But if it turns around and stays here, then that means we've got our momentum and the power is back. The question is, what is happening to these Bollinger Bands? We look at it on a weekly basis again. Oops. Weekly basis again on NASDAQ 100, and you can see last week again on a weekly we came and we stopped right at 18-week moving average. So as you can see, Friday was a big sell-off. That's why you have this wick. So again, a few weeks ago I mentioned we hit the upper Bollinger Band on a weekly. We came back and this was the support. So watch these because again, they give you the hints. This is what's interesting with Russell 2000. So the Russell last week we stopped at 100-day moving average, hit the Bollinger Band, and this was our resistance. We broke above the 18, and we were the strongest on Friday. Everything was selling off as far as the NASDAQ goes. This was actually going up. So there's a momentum. Now, this is good and bad because we want to know what kind of a rotation is happening and what the market is trying to tell us. Because NASDAQ has been the leading index in the whole recovery, if you want to call, since March bottom. They're up about 25%. Russell has been the laggard. And we go back, I mean, look at from the beginning of June till now, we really haven't done a lot. But there's something going underhood. So that's something I want to investigate more. And yet, as I mentioned, the Bollinger Bands are narrowing. These are my, again, resistance at 1604 for the Russell 2000. And then I went back, and also last week I mentioned that these expected moves, I want to show you the previous week we were way outside of it. The week before we were outside on the upper side. Last week we was 2 weeks ago, we were on the lower side. This week we closed above the expected move. So I want to emphasize this because it's important. What does this mean? And once we go, I kind of made a different segment for expected move, so we can have their own segments. I want to review some of the indexes and sectors and stocks with you. But as far as the IWM goes, last week I mentioned that this behavior was happening in the February's top. So I don't know if there's something going on there or this is just coincidence, but this is not something you want to celebrate. And it's not the sign of, the strength of the market because, we're going both sides. We were way outside. Why this concerns me is, remember, this expected move comes from the option market makers calculating the valuation and the expected move of the underlying assets for the following week, or it could be 2 days, or depending on the expiration. So they're calculating that. So they've been wrong for the last 3 weeks. So something is not fitting in here. So that's something I'd like to investigate more, why we are going outside these expected moves. On the other hand, some of the other ones have respected their moves. Now, the other thing that's interesting, and the question has come, I'm a big bond watcher. I don't trade bonds a lot, even though someday we have 2 or 3 strategies on trading bonds, which are pretty, well, they used to be pretty good when you had the volatility. Look at this Bollinger Band here. I mean, the Fed literally has taken the free market out of the trading. So you would think Friday, with all the news coming out, we got the employment, the president's COVID, with the stimulus package, that's where the money will go, to the bonds. But there's nothing has happened. And that's really, this is not a free market. We're becoming a Japan, in my opinion, if this is going to continue. So there is just complete, we are managing the yield curve. We're looking at what is happening with the 10-year notes. There was nothing. This is what happened on Friday. And then transportation, we talked about it last week also. They've been very strong leaders, and because of what's going on, we talked about, again, all the people shopping and other things. But it mentioned this was a correction last week, and then here we went down and then touched the Bollinger Band, and we stopped right at 18-day moving average. So we want to watch that also, see what the transportation is telling us. Dow Jones had its own world. They were down a little bit. They were kind of flat for the day. Again, the same story. They bounced out of the 100 days. The Bollinger Bands are narrowing. Now, whether we go hit the top of the Bollinger Band, it's telling us there's not a lot of movements. So that's really baffles me, because we're going to look at the volatility index again. And this is what it is. So you would think VIX will be going really high the way it happened before. No news, nothing. They're really contracting. Although it is, again, with a lot of news, it's expanding a little bit, but you would think there would be more volatility. And we're holding the support. So if you were looking at it a year ago, you would say, oh my God, we are at 27, 6, close to 28. That's huge. But right now, the markets are kind of shaking this off. And I've tried to explain it in my own words with the call options, but we'll see if that's going to hold. And then we've had as far as the dollar, it's important to see what happened last week. As you can see, we've had the strength going in. We've been sitting on the 18-day moving average. We go up, hit the Bollinger Bands, we came down, we're back on the 18 days. So here we are. So this is what happened on Friday. It was more of a safety path. So they were looking at, again, as far as looking at the safety in the sense of insurance, so the money moved to the dollar a little bit, which affects, again, we'll be looking at the weekly. On the other hand, you can see we've gone and hit the 18-week moving average, and that's where we had the retracement last week. So we'll see the battle of the day versus the week, which one is going to win. So we've talked about silver, so I thought I'll start with silver. And as you know, I trade silver a lot. I don't recommend doing futures on it because it's very volatile, and it's a $5,000 contract. And it's just not a good idea to do silver, but you can play options on it, or if you're a long-term holder, it would be a good idea. If it hits like the 20, would be a very good area to buy. It hit that 100-day moving average and it bounced back. So here we are. We have a doji here. We'll see how the Monday, if Monday we open up, then that will continue going up depending on what the dollar is going to do. If it goes down, we're probably going to go test that 100-day moving average. And the same thing with gold. Silver follows gold, and gold hit that 18-day moving average on Thursday. I did have a trade, which I will talk to you about, the trade of the week. And then Friday, it just sold off. So just a little bit. You would think, again, the money will come more to gold because of all the concerns, but with the dollar's strength a little bit, that kind of affected the gold. So we were down on Friday a little bit on gold. This is what baffled me. It was very interesting. It's Dr. Copper. So this is a futures. It's HG is the symbol for copper. And what happened was, the copper has done well since, we started the recovery, and has done well. It has gone up with $3. And Thursday, we had this huge drop. I think it was like a 6%. And again, we went and close to that 100-day support, and we bounced back on Friday. So I don't know if there was some internally rolling going on, or somebody, the COVID is taking an effect, because we started since the top of the Bollinger Band. We started since the 3rd week of September selling off. So there is a concern. So copper will be our commodity of the week. So I will explain a little more, but I thought this was very interesting. This is a big bar that we had a drop on Thursday. Following up the last commodity of the week that we had, oh, actually we had the platinum, but before that we had corn. So this is how the corn has basically behaved. When we broke above that 18-day, we've just been really nicely staying with it. We go close to the Bollinger Band and we come inside. We go a little bit outside, come and touch the 18-day. And then we went outside the Bollinger Band, and this week we came down. So it has had a nice run. Really, we look at the stock market and all the other asset classes, and then you look at this, you see that's why you want to. One thing about diversification, diversification is a wealth management, so that kind of reduces your risk. But diversification is not wealth accumulation, or wealth creation. So a lot of successful traders and money managers and someone like Warren Buffett, they do concentration. So they really magnify, learn about a few things, and they go big on those. So what I'm trying to do is, I mentioned corn because I want to diversify if you have a portfolio, but also if you're doing trading, it's a good idea to have in different segments of the economy, as far as the asset classes. So you could have, again, if it's stock market is not doing well, it's a good idea to learn about agriculture, and we talk about precious metals, and we will talk more about commodities, and currencies the same way. So just it's always helps to learn more than less, but then learn really good about a few things and try to not have correlations among them, and then use the opportunity to make the most of it. Crude oil, we talked about what has happened. Again, since September, we've had the demand, and we just broke under the 100-day this week, and the COVID effect. And oops, um, we're hitting the lower Bollinger Band. So let's see if that holds as a support. But there's a lot of damage down there. And Bitcoin, this is the, again, it's more of a dollar play, and you can see again we're just parking right above the 100-day moving average. If you've noticed, a common theme is not all the Bollinger Bands are narrowing. So that's been interesting. This is from Friday. As I mentioned, this is the NASDAQ 100. This is the number of stocks, which is about 19 or 18, I should say. They were in the green. The rest of the NASDAQ 100, which is actually 101, believe it or not, because of Google, they were all in red. So that's, again, that's something I want to see if there's a rotation. Money is moving from these technology stocks, and why is that? So we want to see what happens this week. Because if the money moves away from them, then it could start something, because they are more powerful. I mean, a lot of money is in here, big caps. So we want to learn what's going to happen. So this week is important to see if they will continue their selling or they will get more. I thought throwing the lesson, because I think it's important to know a couple of things happened last week. So I want to share that with you. So you can, there's three things. I want to just share, hoping eventually, once you get into futures, we can share even more trading, but you don't even have to trade futures. You can actually use that knowledge and try to adopt and try it, every month, the first Friday of the month, we have the non-farm payroll. So I thought I'd share what I do. We have the FOMC. We've talked about some of the trades with the FOMC, that we have something called 1, 2, 3 trade, but also the day before, there was a historically in a normal market, you buy the Tuesday before and sell it on Wednesday, right before the, in the morning, and usually it's 80% of the time the markets are up. So the non-farm payroll trade, and then I want to continue with our gap trades we discussed last week, and then just briefly talk to you about selling calls versus selling puts. So I'm trying a lot with you, but I hope you can watch this again to understand. So this is Friday morning. As you know, the non-farm payroll numbers come at 5:30. And the markets, actually, the cash markets opens at 6:30. The good thing about futures market is they're open almost 23 hours a day. So it continues till Friday afternoon at 1:15. They reopen again on Sunday at 3 o'clock, and this cycle keeps going on and on and on. The trade I want to share with you is a non-farm payroll. Historically, if you're up at 5:30, even if you are not, what happens usually, what happens, the high or low of the day, again, you have access to the futures market. You could even use Finviz, because Finviz has this. You can do it on a 15-minute. TradeStation, I think with TD Ameritrade, I think with all of them have it. Historically, the high or low of the day is made in that between the reports number and the opening of the cash. So between 5:30 and 6:30. Sometimes even that 5:30 has such a bounce that becomes a high or low of the day. So I just want to share this with you again next month. It's going to be most likely after election. So what's going to happen? Just a food for thought. Hopefully you will be trading for a long time or doing some investing, daytime investing. So this is one thing that I use, and that's also, if you put it in mix it with the gap trade, you will see it usually puts your odds in your favor. So this is, I've mentioned, nobody has crystal ball, but we just learn from the history and we look at the patterns and we say, well, what is the probability of this succeeding, this trade? So as you could see, the high of first of all, the low of this day, which has happened before 6:30, 6:15, it held. And that was it. So if you were going to short it, let's say here, you knew it would be your stop loss. But this becomes a window, and as you can see, once we went above that, this became your support, the high of the at 5:30 opening. So anyway, not the opening, but the non-farm payroll. So that's one lesson. The second lesson, we've talked about the gap fills. And again, there's a lot which could do really class, like for 2 or 3 hours. I can go over all the different rules we could use. But I mentioned to you I don't like Mondays. I think last week Sean even asked me about, and I think Jean-Claude, you've asked, is this was Monday's gap. So as I've said, I like to trade Tuesday, Wednesday, Thursday. Those are the better numbers for gaps. And also the gaps usually get filled 80 to 85% of half of the gaps get filled. Depending on the day, it could be 65 to 75% of the full gap. Depending on, again, these are all the rules we'll talk about. If it was an outside day, did we hit the high of the previous day? So there are rules. What is the odds on Thursdays? What is the internals telling us from before? So just for simplicity, I just want to show you, when you have such a big gap, so it's like about 1%, and it's on Monday, historically, you will not fill that gap. So we didn't even get close to even quarter of it. So you can see this was on Monday. This is Tuesday, it was a very small gap. When there's a small gap, it closes very fast. So in this case, you can see we opened here immediately. We just closed it within 40 minutes or so. So this is not even that, 30 minutes. So this gap was filled, and then we sold off. We use Fibonacci numbers and other things to even give you more pinpoint. So that's the Tuesday's gap. And then Wednesday, this is actually a gap. We opened here. It's a very small gap, but that was filled. The market went up and never looked back. So that was one gap from Monday to Wednesday. And then you can see on Thursday, what we had was, we had a big gap. It's a Thursday, so you know, usually the gaps work. The half a gaps usually get filled. As you can see, we did fill the half a gap, but because it was more than 1%, it was not completely closed. So that's, again, the odds are you want to see this half a gap basically held with support. So, and then we bounce, you can see we've just been bouncing back up and down on this. And this is the Friday gap. So this is a non-payroll, and there was a lot with the news and other things. Even with that in mind, we still again close half a gap. In Russell 2000, we actually filled, and the Dow, we actually filled that gap. So if you do play, and that's the beauty of this, you want to use different indexes. S&P is the most followed, so all the big traders use S&P. But if you would have followed YM, or the mini Dow, or Russell 2000, you would have seen that actually the gap got filled, the whole gap. So anyway, this is the second lesson I thought to share with you. Even if you are not doing trading, maybe you can play with your options. Even if you do like Apple and big cap stocks, or some of like Boeing, being part of the Dow, you can follow that. If you want to do maybe options for half a day, which I think we will talk about the next, you could actually do day trading with options if you like. So before I do this, before I go to the commodity of the week, the third lesson I thought it's important to know is selling calls versus selling puts. Which one is more efficient? All right, because I know some of you do, it's a little difficult to do naked. So basically there are the cash protected trades you do, which you have to put the money in the margin, so it takes a lot of your money. Historically, the put selling, if you're going to have option and you believe you have a bias, let's say you say the markets are going to go up, then put selling works in two ways for you, because number one, what happens when the markets actually started going up in this situation, basically because you sold the put, again, the value of that put keeps going down. So that's why it's important to, it makes more sense in the sense that when the markets are moving up, what happens, the price of that put goes down, so which is to your benefit because you sold it. The second thing, what happens when the markets go up most of the time? The markets go up, usually the volatility comes down, right? So most of the time, again, we've been in a strange world, but majority of time when the markets are taking a trend and they're going up, the volatility comes down. So if you're selling put, you win in two ways. Remember, when the volatility goes down, the price goes down. In this case, we were selling put. So when the market goes up, the price of the actual option goes down. So you win in two ways. So that's a win-win situation. So most of the time, I recommend you're better in selling puts than actually naked calls, in a sense, although you have the margin. When you sell a naked call, majority of the time, remember, if the markets actually drop, well, this is to your benefit, right? Because the price of the call that you sold, because you were negative, it actually, the price comes down, which is to your benefit. But what happens when the price comes down, when the markets are selling off, the volatility goes up. So what happens when the volatility goes up, the price of the call goes up. So it's kind of a neutralize each other with the call, and because of the price is going down, that's a positive. The volatility goes up, that's a negative. So in that case, it's okay if we do covered calls, that because you actually own the stock, so you don't mind if the price is going up, that's fine, at least you're making money. But majority of time, if you want to have a choice, I would rather emphasize selling puts. Last month has been unusual. We talked about the volatility actually contracting. So in this case, if you were selling calls, you were actually, again, if the market was going down, you were making money in both ways too. So it has played both for put options and call options, but even more on call options. But historically, if it was a normal market and you were doing, I would recommend to sell puts. If you don't have a covered call and you were doing naked call, the exposure that you have obviously is infinity, right? So the market can be a takeover. It's a $10 stock becomes a $100 stocks, for instance. But the $10 stocks can be a zero. So you're looking at the 9-to-1 risk of call to put. So just be careful with that. So just I thought to share that with you. I hope that kind of clarifies some of the my choices. All right, let's talk about the commodity of the week. As I mentioned, uh, copper had that big drop. So why copper is important? Copper is called Dr. Copper for a reason, because first of all, it's the third most used metal in the world. So besides still iron and aluminum, copper is the third most used. It is one of the oldest metals. It's been around since 10,000 years ago. And what happens with that is, you know, in Anatolia, mountains of Anatolia, in like Turkey, they've found 6,000 years ago. Even in Michigan and Wisconsin here, it goes back 3,000, 5,000 years ago. So they've been in China. So they've been all over in Africa and in South America. So there are been, you know, we talk about Bronze Age, for instance. Well, bronze doesn't mean anything because it's a mixture of copper and tin. makes bronze. Copper and zinc makes brass. So copper obviously has been around. Copper has made a huge contribution for industrial revolution, and that has helped. Dr. Copper, the reason it's important because it's very much economically oriented, and it tells you about the health of a global economy. So it gives you a heads up, and we will review why it's important to understand copper and its movement after looking at the demand factors and where is it used. You'll see why it's important to understand copper. Just a couple of tidbits. Just I like trivia, so here we are. First of all, copper. The name comes from during the Roman Empire from Cyprus Island, so it comes from Cypricum, and that's when they named the metal after. And then when continuing moving, it ended up becoming in English in copper. The second thing is, believe it or not, we look at, you look at your pennies, and of course it's copper color, and you would say, wow, this is made from copper, but only 2.5% is really, it's copper. The rest is like zinc. So 2.5%, 97.5% is zinc. So here you are, that on the other hand, dime, which is silver color, and quarters are silver color. Dime is 90% copper. Just you figure it out. So anyway, so those are the two tidbits. So let's evaluate why copper is important. Now this is just the United States, but it applies a lot of different places, and you'll see how important that is, especially in China and India, is because of this building construction. Because copper is very conducive, it can transfer electricity, heat, its resistance to corrosion. That's the reason they use it in building construction. They use it in electrical and electronics because, again, it's a great conductor. It's like gold, it transfers electricity, and that's what, like, even in cable wires and internet, they are used in cars and radiators. They have a big usage in again in transportation equipment, and even in medical. Even they're very healthy. I mean, your body actually needs some copper, so they're medically very resistant to virus. They're also, as far as the minerals that actually can be used, and then they as I mentioned, in the medical department, in dentistry, I mean, they're used in so many different ways, and that's why it's important to understand it in the machineries that are used. And again, the building, this is the most important thing, though, in the construction. So when you see there's a demand, that shows the health of the economy. So that's why it's important to understand where is copper today. So this is from July, and then this is cities looking at how was the movement. So they looked at it and they see there was a 5% growth in building, and then the cooling system, that, as I mentioned, the radiator, appliances, automotive, and type of electrical industrial. They were all growth, electronics, except the non-electrical and telecoms and others. So this was the use of in July. And we want to see where's the biggest production. This is up 2018. It hasn't changed much. But Chile, well, Andean mountain range region, which is Peru and Chile and Bolivia, but the majority of the 45% of the world's production comes from there. So Chile has the #1 producer, Peru, and then we have China, United States, Australia. These are the big ones. Mexico is also. Now there's Zambia. Zambia does a lot of exports, actually. They do a raw copper. Mongolia and Kazakhstan, there's new mines have been found. So that's very important to know. One of the things about copper, the production, again, because it's still there's a demand for it, there's two things. 1/3 of copper is recycled, so that's good news. So that's what happens. The bad news is based on the numbers that we have from the mining information that I could find was, again, based on that, there's about 50 to 60 years of supply left in mines. So that's what how much is left. Depending on the usage, eventually, that's where we stand. So, I mean, the recycling is good, but that's what we left at. So, um, I just want to show you the numbers. You can see Chile has 5.3 5,000 or 5,300,000 metric tons. And then you can see Peru is second, United States, and China. So these are from 2017. As far as the consumption, and this is it's very important to understand and why copper had these wild rides. And we go back to 2011, December of 2008, I was buying copper. It had never been that cheap. And my reasoning for that was I'd actually bought futures on copper and also bought Freeport McMoRan, which we will talk about the company, because copper had hit $1.50. And it was under the price of explorations and mining. So why would any mine company spend more money to as far as explore or mine the copper if they were going to get less? So we knew this supply and demand eventually is going to even out. So, and China has been a big player with their growth strategy. So obviously when the COVID happened and China was in the forefront, it affected the price of copper. China is about 51%, but India also is very, and it says other Asia, but India is about 16 to 18%. So it's huge. So those countries' health is what is affecting the price of copper. So, and we're looking back and we look at what has happened. The inventories have been actually going down. So in this situation, that explains the price of copper recently. The other thing is, I did mention that. So we understand the importance of copper. So what are some of the big companies that they actually are in the business of mining copper, and they make, they're the biggest as far as production goes. But by far, the Freeport McMoRan is number one, and then the other companies are from all over, from Australia to Canada, and Peru, and we also have from South Africa, we have Brazil. But I chose two, and my reasoning, two companies I thought it would be good to understand. Just, oh, by the way, this is the, I'm using squeeze, by the way. This is the price of copper. This is using linear regression, and this is what happened on Thursday. Again, statistically, I'm looking at this. Well, we went outside the 2 standard deviation. Boom. We came back up, and we are in the squeeze right now. So let's see if this color changes. But just purely from, I didn't put the 30 minutes. I usually like to look at the 30-minute squeeze, but you can see how the copper has reacted. But this has had a nice run when the slowdown happened, and then we had another nice run. So the COVID story. So there's this is, you can find it on your own on stockcharts.com. The symbol is, this is the futures. It's like just a copper cash actually. You can just put copper, it gives you the price, which is again the same thing as futures, $2.98. This is where we've been. I also looked at the company. There's two companies I chose, and my reasoning was, granted, there's BHPs of the world, and they do mine a lot of different things. There's SQM, the Chilean company, Sociedad. They all do, but the purely copper is the free. So they do a lot of, but the majority, the Freeport McMoRan is really big copper producer. This is the weekly, and I think I had done, um, let's see, around here we had a session, we did it together. Pre-pro was about $5, and I thought that was a steal actually. So, and you know, we talk about Tesla's out of the world, which has done fantastic. We talk about technology stocks. This is a copper company, and probably a boring company, but we went from under $5 to over $17 at the same time. So I thought it's good to understand that this is our daily. You can see we've kept it above the 20-day moving average. It's how nicely it has kept it up. We broke down, and even on Thursday it didn't really break down. It was Friday we had a nice bounce. So there's one company is this, the other one purely as far as copper goes. It's the Southern Copper. It used to be called actually Southern Copper. It's like now it's SCCL, and used to be symbol was like PCU, Peruvian Copper Company, PCU, but now it's like SCCL. So this is another pure company if you ever wanted to invest in copper. Right now we are under the 20 and 50-day moving average, so just watch it, 50-day. So that was two suggestions if you want to invest in copper. If you don't want to, you want to be diversified and use exchange traded funds, there's one, it's actually copper CPER, and you can invest it in that ETF if you like to. The second one is whoops, going back. The second one is JJC. It's the Bloomberg one. It's less liquid. JJC is ETN, so it's exchange traded notes. So they actually, it's a note. It's based on Bloomberg. The exchange traded fund, they actually own the stocks. They're not even futures oriented, so they own it. So that's just a food for thought. These are just a couple of companies I thought to share. Okay, let me see how we're doing time-wise. Okay. So the trade of the week, I showed you the dollar, I mean the gold. So the gold, you know, we bounced, and this is my, again, I use the 8, and then I use the 21 in this situation, and the 50 days. So the red is the 50-day, you know, we are, this is our 8-day. So I done a couple of trades. So on Thursday, we were right around here, and I thought more of a nervousness, and I usually do trade on Thursdays with gold, but I knew there's like right around 179 there was resistance. So what I did, I usually hold it till Friday. So I actually bought contracts of the 178. So I want to be in the money. And the reason I want to share this with you again, it's not, the idea is not about winning or losing. It's the idea about having that system. And I want to ingrain it in you to have your, as soon as you put your trade in, you have to have all your targets in place. And I had a busy day actually, Thursday and Friday, I had a really busy morning. So what I did, I put my, usually I wait till Friday to get things filled, but my 25, 50, and 100% targets. So this is where I got in, and within a couple of hours or so, all my targets, including the last one, was hit at 100%. I usually try, again, because of that 179 resistance, I didn't want to hold a runner. I usually hold one runner to say, well, if it goes up 400-500%. And this was like a one-day option. That meant it was expiring, as you can see, October 2nd, which was Friday. And because of that, if it was expiring, then there was the theta was 30-40 cents of the whole price. So I bought it a little over 80, I think about 90 cents. So the next day, automatically, I would have lost 30-35 cents just because of the time decay. So I'm very happy if I can get quick money, then I'm done. I didn't realize it's going to happen that quickly, but I was out by on Thursday, and then you can see what happened on Friday. So, everything else, but it was hitting that resistance, so I needed just a quick. So that's using the charts, but also the discipline. I want to ingrain that discipline in you. Make sure you put your targets as soon as you get into the option. And so that's where the resistance came from. The second thing I did, if you recall, a week ago, we did a class on in and out option play. So basically, what was the idea? It was a vertical spread. But remember, vertical spread, we'd rather go out of money and further out of money. So basically, we either finance it, and if you're bullish, that in and out was if the stock is in the sweet spot, let's say at the money is at, in this case, when I got into my gold trade, was at 174.5. So what I did, if you recall, I showed it last week on silver, for instance, I went out 1.5, that's out of money, and I went in 1.5 in the money. So basically what I did, I bought 173 call and I sold 176. If you recall, one of the rules was I want to have between 90 and 50-day expiration as far as the time. And in this case, we were about 22 or 3 days. That was last week I did. And so basically, and the target is, you want to make 25. I mean, if you make 50 or 60%, you're out. But, if it's 30, 40%, this is a vertical. So it was just one of them I thought to share with you because I got out of it. So basically, this was my long call, and this was my short selling. So I just want to share with you what happened to my vertical spread up in and out gold trade. So that's that. And then I think last week I mentioned about insiders. I thought about this company does the Latin America communication. The fundamentals are not very good. The chance that it's in the gray area for bankruptcy. And I mentioned to you, it would just intrigue me to see, the couple of insiders, including the CFO, decided to get into this after a long, they had not been more of a seller. So why it's that? So I'd like to nibble, but just the option market is very, very thin on this. So I didn't want to, but I said, why not? I just do a little bit of that. So I got in and I still haven't hit my target, but that was just more of an insider, nothing else. So this was, the support was 810. And basically that's where I've gotten it. And all I care is just make $1 per share. That's it. This is not a valuation in the sense that, it's gonna go down to up to $20. I'm gonna hold. The fundamentals don't justify it. So I was curious about the insiders. Usually you want to hold maybe few because they cannot sell for 6 months, or maybe that's good news to hold it. For me, I just look at it as a swing trader. I will get in. If it hits my $1 target, I'm out of it. So there's nothing wrong with, it's 1,000 shares or 1,500 shares. I'm not sure that 1,500 or so shares. I'll be happy to get out of it with a little bit of profit. The reason I say this, if you recall, a couple of weeks ago we talked about Valero. I used that example like VLO, and that was again outside the bands, the Bollinger Bands. I did the options, and then if you notice, that was it. You have to understand why you're in a trade. If you're day trading or if you're swing trading, don't become an investor. Don't justify because it's going down and say, oh, it's going to come back up. Have your discipline and your time frame. For me, the VLAO, and I shared it with you, that was a short term. It was outside the bands. All I cared was I got on like 44, 45. I got sold options and I bought actually stocks itself. I got out at 50, and it went down to 39 2 days ago with the price of oil and everything. It's at 40 or 41 now. I don't care if it goes to $100. I'm done with that trade. Now I'm out of it. So, and it's not something, it's not one of my favorite stocks. It just came based on my screening, and I got in, did the job, and I got out. So you look at this as a business, please. Just don't look at it as a, again, I've said it before, like a marriage or relationship. Just go in. If the business is good, you did it, out, you shake hands, and you're done with it. So, okay. So that was, I thought it's important. All right. Let's talk about expected move. So this is for the SPX, as you can see. I just, again, you can refer this, you can just put the numbers down. And this is where SPX, look what happened last week. And that's where this is important. So the market makers, they actually, you can see it's been pretty orderly with SPX. So S&P, there was one time here, it went outside. But other than that, last few weeks, look, even the week before, we hit the lower band, and then we came back up. Last week, on Thursday, we went over, and then we came inside. So 80%, if I have this knowledge, knowing those boundaries, so don't you think if I go like really outside, and that might be 70, 80%, maybe it would be a good idea to buy put options maybe, or maybe sell a call. Again, it's odds. I mean, if I'm wrong, then so be it. If I'm right, the odds are in my favor. So I look at some other thing, but this will give us, so you can see we've been orderly. Now you can see that the markets are looking step up here. So this is where we are now. So in this situation, you know, I think that the markets are, you know, taking to 80 something up or down. So I just thought, since you have access to the slides, you can just write down the numbers. In this case, like 34, 36, 50, and know where is the high and what is the low. So I want to go one step further and just look at, let's say, QQQ. Again, QQ, it went outside and it came and closed on Friday and really down, but it closed inside the band. The same thing with financials. You can see financials were keeping and just tiny bit went outside. So they actually finished on the positive on Friday while NASDAQ was really selling off. I thought I used Apple, the same thing. Apple was respecting its boundaries. Again, while one time it did go outside, but after that, you know, we've been staying within. Last 2 weeks, we actually have been on the upper band, but then Friday, as you know, a lot of, including Tesla, they all had a big drop. So I tried to share that with you. And the same thing with gold. Gold, again, that was, you know, Thursday. I was so glad I was out of it on Thursday. I just have this habit of doing my trade, but I was very cautious. Didn't do a lot of, I only did 5 or 10 contracts, I think, not many. But it's just a habit. But I just see we were outside the boundaries. So, and then crude oil, we are way outside now. We can see that what is, oh, I'm sorry, this is corn. Now we are way outside. So if you were holding corn, I would have recommended, like on Wednesday or Thursday, I would have said, you know what, lighten up a little bit. This is a good time to get out. But still, the future looks, you know, we have a couple of resistance numbers coming, but it's been a really nice run, especially if you played options on it. I mean, this would have been a good time because we did go outside the boundaries. So we still, you know, looking, the trend still looks up, but I would lighten up if you are holding any type of coin, just take some profits. And this is our 10-year note. I mean, look at this. It's just been contained and nothing. Nothing has happened. And again, this tells you, except this time we just haven't had a lot of movement in 10-year note, which is, again, it's all Fed. All right. Okay, let's see, how did we do? time. Okay. Thank you so much. All right. I'm done. I really appreciate your patience and your and I hope it was informative and Sean, we can start recording and maybe